Good afternoon, everybody. Can you hear me? Hello, hello, hello. Can anybody hear me?
Good afternoon. You're very low, Mr. Wilkinson.
Very low. I wonder what that's all about.
Okay, better now.
Better?
Yeah, I can hear you clearer now.
Okay, great, great. Just give me a moment. I'm just trying to find my notes here. Wondering where we went. I'll be with you guys very shortly. Hmm. Just trying to find my link. It's not that. Where did my notes go? Why is my link not working? Okay, first things first. Let's see who is here today. Natasha.
Good afternoon.
Yes, hanging in there. Andrika.
Good afternoon. I'm here.
Way to go, way to go. Let's see. Edrika. Okay, Edrika is dealing with some issues. Cheryl.
I'm here. Good afternoon, all.
Afternoon. Okay. And then Jerry. Honeymoon. I see him trying. Okay. He'll join us shortly. All right. Well, the homework. Does anybody still have homework from chapters 10, 11, and 12?
I have the homework. Which chapter was that for the current liabilities 11? I have that homework for you.
Chapter 11.
Me too, Mr. Wilkinson, Natasha.
Okay, chapter 11 as well.
Yes, sir.
By the way, that was Enrico.
Andrika, yes. Okay, so that's fine. That's the last of it. So as soon as you can get it in, please send it in. So in case I see any real heavy anomalies, you know your midterm is on Saturday morning, 9 o'clock at the Institute. They're going to have everything ready for you. Get a good night's rest tomorrow night. Go in fresh and excited, and you'll do a far better job under those conditions. I really didn't want to get into any new material today because I wanted you guys to stay focused on your upcoming examination. So what I shall do today is perhaps use some time to do a little review. If you guys have any questions, for example, any topic issues that you'd like to raise, anything of that nature.
I have a few questions. One of my questions will be like, when asked to do a journal entry, do we have to do a T account? Like, do we have to post it if we're not asked to post it?
That's a good question. If you are not asked to post it, then do not do any postings. Now, some students somehow find posting stuff therapeutic, even though they're not required to do it, and so they go ahead and do it for some reason. But no, if it's not asked, then there's no need for you to do it. If, for example, you're asked to journalize some transactions and prepare financial statements, then even if you're not asked to post, you know by now, hopefully, that you can't really prepare proper and correct statements unless all journal entries are properly posted first. And then you'd be using the balances from those posting those posting ledgers to prepare your financial statements. So good question. So if it's just a plain out prepare journal entries, that's all you do. It doesn't say post, don't post. Okay, for sure. But if it says prepare financial statements and you have journal entries to do, then you know you have to post them before you can get the accurate numbers for your financial statements. So you would have to show the postings under those conditions. Okay.
Okay, and when the question states that like they don't specify what interest is it, we could assume it's simple interest based, like they just say interest. We could assume we calculated it like a simple interest because if it was compound, they would specify, right?
That's an issue. I'm glad I took this to do the review because nice, some important questions are coming up that really didn't come up during the classroom session for some strange reason. Assume simple interest. Let me say this. you shouldn't get a question like that where you have to assume it. It should be said clearly that you are to calculate using simple interest and or compound interest. However, if for some strange reason a question shows up and none of that shows up and it's just to calculate the interest, then go ahead and use simple interest. Okay? But you shouldn't have to guess. It should be stated very clearly which ones you're required to compute, either one or the other or both. Good question.
So I have something more specific to one of the questions we did for homework, which is P7.
Which was P7?
Problem 7, yeah.
Okay. Which topic was that?
That was interest expense and accrued interest. Interest payable.
Okay. And what was your concern? It's a good time to raise it.
With Quan and Rice. So my concern was when they asked us to, on June 30th, calculate the accrued interest.
Right.
I was wondering if it was calculating it for 9 days or 60 days. Because June 30th was only 9 days after May 21.
What happened on May 21st?
Well, May 21 is when we had the extension of the accounts payable, the trades accounts payable for 60 days.
Okay, what was the original date of that note?
I have no idea.
Does it tell you what was the original date of the note?
I don't think it does. I think that's when my
Anybody?
confusion started.
Okay. Anybody had the same problem? Like, did they tell you the original date of the note? Like the note was processed on January 1st. Anything like that?
I think so.
The note,
I-
it obtained a 60-day extension on the 21st. The fiscal year ended for 60 days. The fiscal year ended on June 30th.
June 30th. But the
Mhm.
extension was on June 21st.
May 21st.
May 21st.
Mhm.
Yeah.
And it's a 60-day note.
Okay, you could say the date of the journal entry was May 21st, obtain a 60-day note extension.
Yes,
Uh-huh.
so the date of the note was May 21st.
Yeah.
Indicating that they obtain a
The word-
60, okay, yes, that would be like a new note because it was a 60-day extension.
Right.
So you can assume
the
that it's
word
May
extension-
21st then.
Yeah, May 23rd is the extension date for 60 days. Now, the fiscal year end is when?
June 30th.
June 30th. Now, if this is a 60-day note, by June 30th, 60 days would not have passed.
Right.
No,
How many days would have passed from the date of the note to June 30th?
9.
that would have been about 40 days.
Yeah, it would be 40 days. I got 40
Wait.
days.
What is the date of the note then?
May 21st.
Right.
May 21st to June 30th is 40 days?
Yeah, because remember, June 21st, that's 1 month.
Or y'all, I calculated May 30th.
Oh,
Yeah.
yeah, no. Yeah, you went to May 30th, but the actual fiscal year end is June 30th.
Hmm.
So you have to calculate up to the year end date, which is June 30th.
I see.
You see? So that will give you 40 days divided by,
365.
is it 365?
Yeah,
You sure? If you go back to your notes on how to calculate note payable, would you see over 365?
yeah.
The days? Yeah.
Most of their days are
For the-
365.
65.
Well, I'm thinking you could use either or, right?
Mm-mm. This is interesting.
But I noticed the examples in the book normally carries 365 days.
Okay, so, 365 days suggests the notice for 1 year, doesn't it?
No, but if we divide 40 by 365, that's how we calculate that it's
Yes.
40 days.
It's 40 over 365.
Is it a 1 year note?
No, it's a
No.
60-day note. What we
60-day
calculating
note.
40 days for. So that's why we're putting it over 365 to calculate what 40 days would be in a year.
Very interesting. I was waiting to hear some pages, people going back to check that section on how
I
to
did
calculate
check that
interest
section.
on a 60-day note.
Okay.
If you go back to the chapter to see how to calculate interest on a 60-day note, what do you see?
So if we look at page 414 in chapter 11,
That's what I'm talking
we
about, page
we look
414.
or 413, they calculate two different days. One is
Okay.
a 60-day and one is 30 days. And they put both over 365.
They put both over 365?
Yes.
Yeah.
Okay, and what was the information given for the note? What did they tell
Okay,
you?
so
It's
when they
at
calculate,
14%.
yeah, when they calculate on page 413, when they calculate 60 days, that the note payable was just issued and they trying to find an interest expense.
Okay, what was the narrative? What was the data?
On that one, she paid the note, the 16,000
16,000,
plus interest.
3% for 60 days.
3% for 60 days.
Uh-huh.
So there was no year end in that example. Like there was no fiscal year end that came up at the time the note happened.
No.
No. What if you look at the example about when there's a fiscal year end between the date of the note and the date of the maturity of the note? Yeah, hunt around for that example. Snoop around. It's right
Okay,
around.
they have the accounting on page 414.
Mhm.
The accounting period ends on January 31st, 30 days after the note was issued.
Which is 30 days after the note. How
Mhm.
long was the note for in that example?
It's still the
60 days.
60-day note, but
60 days.
now
You're calculating
trying to
interest
find
for
the
the
interest for the
fiscal
30
period.
days
Yeah,
that the period ends.
since the year ends January
Mhm.
31st, then we have to accrue the interest expense for the first 30 days up to the end of the year. How was that done?
That was done over
The face of the note is
365
The face of the note times
times the percent
the percent times.
times the 30 days over 365.
Okay, fair enough. So that supports Angelica's argument earlier that it should go over 365.
Yes.
Okie dokie. Okay, Angelica, so far so good. So where else did you get stuck?
You know, I just everywhere, but you know, I be thugging it out.
No, that's okay. I want you to throw it out so we could hunt down any issues that might be a bother to you right now.
Okay, so let's just say I make a journal entry, right?
Mm-hmm.
Let's go back to, I think it was E2A.
Mm-hmm.
I make a journal entry
Right.
and I'm looking for E2A, sorry.
That's okay. That's what this class is for. Hunting around, asking questions, getting things sorted out in our minds that we're stuck on still.
Okay, so notice that on November 30th, we have interest expense debited for $591.78.
Okay.
But on December 30th, interest expense is $1,183.56.
Okay.
Technically, let's just say we were supposed to set a T account, interest expense would be more than it should be
Why?
because I calculated $591.78, the first interest expense for 30 days, and then I calculated the second one for 60 days, but the second one still includes the first 30.
Why?
Because I calculated for the full 60 days because we were paying it off.
That's what they asked.
Why did you calculate it twice? One for 30 and one for 60?
Because they said to record 30-day interest expense, because that's
Okay.
when I guess the fiscal year was closing off.
Okay, great. How much is interest expense for the 30 days?
I have $591.78.
What was your entry?
I debit interest expense for that
Uh-huh.
amount, and then I credit interest payable.
Okay. And I
When
guess
I come back on December 30th and debit interest expense again, I debited for twice that. So technically,
I know where you're going.
yes.
But wouldn't April 30th transactions like balance to zero because you have a debit and a credit for the same amount?
I don't have a credit for interest expense.
Well, like everything else.
That was already expense.
Well, let's back up. The first entry is as at which date?
October 31st.
Okay, so that was a 30-day interest entry. That means the date of that note was October the 1st.
Perhaps.
No, it's October 31st, 60-day note.
So the date of the note was October 31st.
Yes.
Okay. And it's a 60-day note.
Yes.
Okay. So that means the note matures when?
December 30th.
December 30th. Interesting.
Wait,
So
maybe not December.
So why did you calculate the 591?
Okay, because it says here, November 30th, accrual of interest expense.
November the what?
November 30th.
30th, interest expense had an accrual, so we just calculating how much it would be at that time.
Right. How do we know it's 30 days at the end of November?
Because that's a good question. Because from October 31st to November 30th is 30
From
days.
Yeah, that's what I'm trying to get at. The date of the note is October 31st.
Uh-huh.
From that date to November 30th is 30 days. So as of November 30th, you have to calculate interest for 30 days, and that works out to be 591, is it?
Uh-huh.
591.78.
So
Okay.
when we come back on December 30th, how much are we calculating it for? 30 days or 60 days? Because I
Well,
want to
what?
know.
Depends on what it is.
No, yeah, like what is after you did the 30-day interest calculation, what was asked next?
They
December
said
30th, payment of the
payment
note
of the
plus
note.
interest.
Payment of the note. What was the face amount of the note?
60,000.
Okay. Now be careful. Part of the interest has already been expensed 30 days before, correct?
So we only need to
Mhm.
expense the
Oh.
second half.
That's the analytical side of accounting. So it therefore follows that if the first part has already been expensed, therefore, you will only have to expense the second half.
Shoot, see, I made a T account and I was like, okay, this T account ain't balanced. And
It won't
something's
balance
weird.
until you get a correct journal entry.
Yeah.
What I did on that, I even didn't when would I
Well,
expense? No, I didn't expense it.
I followed the book.
Thank God
And
somebody followed the book. That's what I was hoping to hear.
What
I
you-
followed the book.
I
because
followed the
it
book too, but then
said
I did it wrong.
You followed the book and still
I
came up with
didn't
something.
tie in 1, 2, and 3 to each other. I just did what each one asks.
Right, that's what I did.
It's-
So on that one, I did.
Andrika, I think you're probably trying to tie them together, and that's what probably have you
No, man, it's
No.
all one thing.
No, it's all one thing. She's right.
okay.
All right. Be careful, because students get stuck on this all the time. Are these individual cases that are not related, or are they related? You have to make sure you know which ones are connected and which ones are not. Okay? In this,
But hmm.
And
Oh.
then why it made sense is because the 491, 591.78 times 2 gives you the 1,183.56.
Is
well,
that Natasha or Cheryl?
listen now,
Natasha.
it'll always work out if you're doing it correctly. First of all,
Mhm.
Okay,
if you calculate the interest for 60 days, what do you get? Forget everything else.
you
Calculate
get
interest 60 days.
1,183 and
And
56
56
cents.
cents.
So now we know what has to be paid. However,
That's what has to be paid.
however,
Mm-hmm.
the first 30 days accrued after 30 days. So part of the interest was already expensed in the first 30 days. Now, why was this asked of you? Was November 30th the year end?
It doesn't say.
You sure?
Let me see.
On the last day of October, Lake Company borrowed 60,000 on a bank note for 60 days at 12% interest. Interest is not included in the face amount. Prepare the following journal entries. 1. October 31, recording of the note. 2. November 30th, accrual of interest expense. So it doesn't say why we are accruing it. And
Okay.
then 3, December 30th, payment of note plus interest.
Oh, okay,
So
great,
so
great.
so I assume that when I
No,
heard
no, you don't have to assume. Let's go back.
You
No,
see
don't
these,
assume. Let's go back to question one. What was question one?
question 1, recording of the note,
What was the entry you made?
debit cash for 60,000 because we received cash, and then credit notes payable because it increased for 60,000.
Good. Now, number 2.
Number 2, we debit interest expense because when an expense increases, it debits for 591.78.
Right.
Number 3,
No, no.
no, not number 3, but we still on number 2.
Yes.
Next, we credit interest payable because when a payable account increases, it's credited for 591.78.
Now, stick a pin.
Stick a
So,
pin.
we record the transaction. We record interest for the first 30 days.
Mm-hmm.
And in recording the first 30 days, we account for 30 days of interest expense, and we created a liability to say those 30 days of interest expense is still payable. You haven't paid it yet.
Mm-hmm.
Okay? You've expensed it in November, but you haven't paid it yet. Correct?
Correct.
That's what payable means. You still owe it. Now, you won't pay it until when?
December 30th.
Correct. Now, number 3, December 30th rolls around, but only 30 days of interest is due in December, correct?
No, everyth's due in December.
they paying off the entire interest.
Oh,
This a
listen
payout now.
carefully. You're paying out the entire note, correct?
Correct.
Right?
Normally,
Mhm.
you would debit interest expense for 1,000 and whatever that is, right? Right?
Normally, yes.
But you're not doing that because you already expensed 30 days.
Yes.
So you only have 30 days more to expense.
That was my question.
Yeah, that's the point. You already expensed the first 30 days. So come the end of December, you only have 30 days to expense. So what will that interest expense be?
Interest expense in December 30th is 591.78 again.
Good. Stick a pin.
Sticking that pin.
Right.
Now, what's the rest of the entry to pay off the note?
So to pay off the notes payable is we're gonna debit that by 60K.
Okay.
And then we're gonna cash, it's gonna be everything. That's gonna be your total interest expense plus the notes payable, which
But
is
you
61.
You didn't pay off the note payable from November yet. Where does that go?
That's
Ew.
interesting. You mean the interest payable wasn't paid off?
No, the interest has already been expensed in November. That when it was expensed, you created a liability called note interest payable.
Uh-huh.
So in December, that has to be paid. That's what payables are about. You have to pay them. How do you pay How do
So
you,
interest payable is gonna be debited,
for how much?
$591.78.
What else will be debited?
Oh,
Interest
interest
expense,
For how much?
$591.78.
What else will be debited?
How come I
Notes
didn't see that
payable,
example?
For
So
how
we
much?
need an extra, so we breaking it down then. The book
Yeah, I
didn't
didn't
break
do
it
it that
down.
way. I didn't see that. I didn't see that example though.
No, the book don't have it
the
like
book
that.
don't have that example. That's
So
why
that's
you just
why I
gotta,
treated it separately,
you
like
gotta
a
use
different
like,
Right.
transaction entirely.
I hear where you're going, but you guys wouldn't finish the journal entry for some reason.
Okay, so we're
We
we're
debit,
debiting.
we debit interest expense for the December, which is how much?
$591.78, and then we credit cash for all of that.
How did we get to cash already?
So we'd have 3 debits.
We have 3
Yeah.
debits.
Yeah, and
Okay.
Andrika wouldn't allow you to see the 3 debit sheet rush over the cash.
I sorry.
Don't apologize, I'm just teasing. So let's go back to the debit side. What are we debiting?
Notes payable,
For how much?
60,000.
What else are we debiting?
Interest payable,
For how much?
591.78.
What else are we debiting?
Interest expense,
For how much?
591.78.
Absolutely. And the total amount, according to Andrika, is?
That would be the 61,183.56.
Yeah, everything
What,
added together.
Mr. Wilkinson, I see why we did it that way, but that didn't seem like what the book asked for.
Okay, what did the
If you
book?
go on by what the book have, you wouldn't have the 3 debits.
Okay, let's go back to the book. Let's go by what the book has according to Cheryl.
You
Okay,
see, because they should have said, taking consideration that it was a partially accrued,
Okay.
I was
okay.
sharing.
you know.
We're gonna go back to Cheryl's version. And according to Cheryl's version, the first entry should be what?
Interest expense for the 591.78
Uh-huh.
and the interest payable as 591.78.
Okay, entry number 2.
Okay, that was entry number 2, actually.
Well, they have 3 questions, don't they?
Okay, one was just booking the notes payable,
Booking
which
the
is
notes.
cash and 60,000, and notes payable at 60,000.
Okay, great. And number 3.
What I did. Mhm.
Okay, number 3.
Number 3, let's go back to this question. Let's dissect this. Okay, December 30th, payment of note plus interest. Now they're paying them out, right? They're repaying the whatever loan they had.
Right.
December 30th, payment of note plus interest. That's all I did. I paid the notes payable debit for the 60,000. The interest plus the interest payable at 1,183.56. And the cash going out was 61,183.56.
Kiss my foot. Okay, let's back up to Cheryl's entry. What did you debit for number 3?
Number 3, I debit notes payable,
For how much?
60,000.
Okay. And what did you credit?
I credit cash at 61,183.56.
But your entry wouldn't balance if you do that.
No, I also debited the interest payable line because that was due. The full interest payable was due to whoever they borrowed it from.
So what did you debit other than the note payable?
That's just the note payable and the interest payable.
How much did you debit interest payable for?
1,183, whatever interest was due.
Did you incur the full interest in December?
Yeah, I paid off the full interest.
No. I know accounting students do this all the time. You have a 60-day note. All of the interest was not incurred in December because in November, they told you that you have to accrue the interest expense for the month of November, didn't they?
But actually what they're telling us that we're paying this off in December. So the full payable amount plus the interest would be due.
True. What is the instruction for number 2?
They talked about if they accrued it for 30 days
See,
at that point in time. I just treated it as a separate entry.
I know. I know you would, and people do that in real life too, Cheryl. They treat stuff
Mhm.
according to how they want to treat it. And that's sometimes when auditors come and say, who treated this like this? And I say, I know, must be Tingham. Because sometimes we don't treat it the correct way. Let's go
And
back
then,
to let's go back to number 2. I know what you did, Cheryl.
mhm,
Let's go back to number 2. They said to accrue interest for November.
right,
So you have to accrue it, no matter what you think.
yeah, which I did, I proved it.
Yeah, so if you accrued it, you debit interest expense and you credit interest payable, correct?
Mhm. Yep,
Now, in 3, where they say paid off,
paid
then,
off note plus interest.
yeah, but instead of debiting interest expense for 1,000 and whatever it is, you cannot do that in accounting if you have accrued the month before.
Okay. Okay, so we gotta be mindful to tie it back to the previous entry then.
Well,
Okay.
what you
I
have
got
to
it.
do, what you have to do is you have to pay, you have to debit interest payable for
Right,
the
I'm aware, yeah,
for November, then you debit interest expense for December. You follow?
I'm following you. I see why it's done that way, but it was just, to me, I just did it separately
Oh yeah, that's
based on
not
the
the correct.
question.
Yeah, but that's not the correct. That would have been fine if you didn't ask you to
If
do
you
it.
didn't do the accrual,
Correct. See, had they gone from button the note to pay the note, no accrual in between, then that would be fine.
and then when I went back and looked at it, it didn't have the example of debiting the interest expense like that for some
Because
reason.
yeah, because the accrual part of it was dealt with under accrual somewhere else. And so they assume like since you learn your ABC, you can read. In accounting, they assume that if you've done like a little bit of something, you did an accrual somewhere. And so
Yeah, it's
yeah,
supposed to be known,
same
okay.
assumption. Yeah, absolutely. Even though it may
It's,
not deal with it directly in the particular chapter, it assumes that you've seen an accrual before.
okay,
Yeah,
gotcha.
absolutely. And if
Don't
they,
make that mistake when I'm looking at the question then.
yeah, that's the whole idea. So if there's no accrual in between, then you can go straight to Cheryl's entry. Debit interest expense for the full amount and then go from there. But once you have an accrual in there, you can't do it that way. Your debit has to be in 2 parts. One to
Right.
expense, one to
Mhm.
payable.
But the expense of the full amount of the
Correct.
interest.
Correct, but you still, well, we already accounted for the November expense.
Yeah, portion of it, right,
In December, we cannot account for November expense in December.
right.
How can we
I'll
account
be
for
double.
December? Exactly. All right, absolutely. It's called the matching concept. That's how accounting works. If the expense, if you get a 60-day note for November and December, November has to have the 30 days has to apply to November, and then 30 days has to apply to December. We cannot cross it over. We can't put all the interest expense in December. That would not be correct in accounting. Okay, so we accrue it and debit the interest expense for November and create a payable. And then in December, we debit interest expense for December and pay off the interest payable and the note. All right. Andrika, did you raise that question?
I did.
Good. It's a good
And
thing you raised it.
Yeah,
let
need
me
clarity for everybody.
let me just point out that I did it exactly how everyone else did it. And then,
Uh-huh.
I have like this habit of like just doing the T accounts just because. And I'm
Uh-huh.
doing my T accounts, right? And I'm just living my best life doing my T accounts. And I post interest expense and I post a debit for
Uh-huh.
$591.78. And I post another debit for twice that. And it just didn't make any sense to me. It was like, why do I have like an extra 1/3 of a debit that I'm not supposed to have?
This is
So we
why.
all do the T account, we would been straight.
No, well, the thing about T accounts is it'll show you where things are messed up. Because she didn't, she when she put it in the T accounts and posted it, she's like, something isn't right here. And then that's what's supposed to take you back to the journal entry to see what you did wrong. That's what we do in accounting all the time. Okay, remember, accounting is not done in a perfect world. People make mistakes for whatever reason. So that was a good thing. So now you can see where interest expense in your T account should have been debited for November 30th, and then for 591, and then debited for December 30th, 591. You follow that?
Follow.
Absolutely. Good question. Any more goodies like that?
If y'all would just, anyone else can raise a question, a million questions. I don't understand present value and future value. So if we could just go over that question, because I didn't know what I was doing, but like, you know, that could be the last question of the class.
It
If y'all
could
know
be.
that.
It definitely could be, Angelica. You know how examiners go. Any old crap would show up once you covered it. So
True.
you want to be familiar with it. But before we get to, and I'm glad you raised that, because a lot of times students don't say anything about present values, and then when it shows up in the test, if it does show up, then they're like, oh, why did God curse me? I should have asked, and so on. All right. So hold that thought for a minute. Let me just say two things while I remember. One, remember those four statements that I told you about at the beginning? Nobody remembers.
One was the income statement, one was the balance sheet.
Okay, keep going.
I'm not entirely,
Statement of owner's equity and statement of cash flow.
okay.
And do you remember what I said about those four statements?
They could possibly show up.
How come you remember that? That means you wrote it down then.
No, I just have an okay
Just
memory.
remember that, yes. And anything else I said about they could possibly show up, meaning what?
True and false. Accounting cycle.
Well, those four statements have certain steps. Remember I gave you the steps?
Oh, the accounting cycle.
Sorry?
This,
Remember I said an income statement, it consists of?
the expense and revenue.
Yeah, nobody wrote that down?
Yeah.
That's again.
Remember, we kind of walked through it and I said, the income statement consists of sales minus expenses equals net income or loss. Remember that? No? Boy,
Yeah.
I hope I don't ask that in the test.
Repeat that.
You were supposed to have written it down the very first night.
Yeah, I think I got it somewhere there.
Yes, you should, because everybody took a moment to write it down somewhere. The question is, where is it?
So much writing.
Yeah, it's there, closer to the beginning of the semester. All right, so make sure you're familiar with those four statements, the steps that we take in order to prepare them. All right? Because it might come up. Net income is equal to sales minus expenses. Equity is equal to beginning equity plus revenue minus expenses equals ending equity. Balance sheet is assets, liabilities, and capital. And cash flow is operations, financing, and investments. You have them written down. Make sure you know how to set them up just in case I ask. I might. Easy way to get some points. All right, the second thing you need to know, this is a hint. Are you ready? Are you ready?
Ready?
Ready, ready.
Get ready like Freddy. You need to know how to calculate working capital ratio.
What is that?
Working capital ratio.
Okay, yeah.
Yeah, that we talked about in the last class. You need to be able to calculate payables turnover,
Sure. Mm-hmm.
and you need to be able to calculate days payable. Those three simple ratios, once you learn them. Now, if you don't learn them, you lose easy points. If you do learn them, you gain easy points. In the event I ask. Now, if I don't ask, don't say that you wasted your time. You never wasted your time.
It's good to know.
Exactly. All right, but in the event I do ask, you'll be ready to go. So keep those two things in mind. All right, let's go down to time value Angelica's question, she's asking all these crazy, interesting, correct questions to ask. First of all, does anybody know what time value of money is all about? Let's see if we can get that sorted out. What is time value of money? What does that mean? By the way, you need to be able to do journal entry for payroll. That's all I can say about that.
That long thing?
It's a long thing. Because what I'm gonna do
Look
is,
at that I say.
yeah, I'm gonna give you a bunch of information and tell you prepare the journal entry for that payroll. And then you have to do all the little calculations using the tax rates. All of that will be given to you.
Knowing all the state and federal income tax?
Yeah, absolutely. Otherwise, Chapter 11 would be no fun.
Right, right. I figure you would ask that question.
Definitely,
I
definitely.
can see that coming.
All right. So I think hopefully we understand the difference. Angelica, let me start with you. Are you there?
Uh-huh.
All right. You remember the difference between simple interest and compound interest?
Simple interest is interest calculated on the face. Should I say face value? Is calculated on the principal alone.
Your face value and principal are the same.
Okay. Whereas compound interest is calculated after the principal and interest has been calculated every period. I don't know if it's going to be a year or every few months or
Usually it's the year, but it could be every 2 years, like, I mean, twice a year, which is half yearly, every half yearly, or it could be quarterly. Either way, it doesn't change the principle, the calculation process. All right, what's the formula for simple interest?
principal times rate times time.
That's it. Everybody agrees with her, PRT?
Yeah.
Yeah? If you say PRT, you wouldn't get it right though.
Principal times rate times time. That's simple interest.
Okay, over nothing? It isn't over anything?
Interest. Interest is always
Over 100?
100%.
That over 100 didn't seem important, huh?
Yes, it
Okay.
is.
Okay. If you if you're using a decimal, then you don't need the 100. But if you're not using decimals, then that 100 becomes very important. All right. So remember in our discussion of compound interest, we said that if somebody puts $10,000 at the beginning of the year at 6% interest, at the end of the year, the interest would be $600. So therefore, at the end of the first year, they have 10,600 in their account. And then beginning of the second year, they start with 10,600. They don't take the interest off. Then they calculate interest on 10,600. So that's how we compound it. We take the principal plus the interest each year, and we calculate our interest based on that. That's how compound interest works. So please don't get stuck.
What's the simplest way of saying that? The interest is accumulated?
Well, different students have different ways of remembering. Okay, typically you're paying interest on interest. That's what a lot of people remember. Compound interest is you're paying interest on interest. In your example for compound interest, are you using a face value of $10,000 in your book? Chapter 11. Sorry, 10 for you guys, I think. Or is it 12? Whatever chapter that is. For compound interest, are they using 10,000 as the face value?
Yes, 10,000 deposit in 10 account that
Exactly.
pays 6%.
At what rate of interest?
6%.
Okay. So at the end of the first year, how much will be in the account? At the end of the first year, how much money will be in the account?
And the first year will be $600 in the account. Where we at? You said we're using $10,000 as the
Right.
principal, right? And it's at
Right.
6%. And that's for the first year. So why
You
is
said
he?
6%, $600? So I could give
Let
you
me get my
$600
calculator.
and keep the 10,000 then.
No, the interest. Actually, that's the
You are
interest.
correct.
I'm not saying that the principal
You are
plus
correct.
interest.
But I didn't say what was the interest at the end of the year. I said, what was the balance at the end of the year?
Oh, my bad,
Ah,
10,006.
Be careful in examinations, things look funny too. Like students say, I thought I got that right. And then we say, well, maybe, but you missed something. And it's, oh my God. That's what that said. Okay. Because under examination, things look a little weird too. So at the end of the year, the balance is 10,600. 600 is interest. At the beginning of the second year, what's the balance? At
10,600.
6% interest, how much is the interest at the end of the second year? Interest. What is the interest at the end of the third year?
674.
That's why we say that compound interest is paying interest on interest. So every year, because you leave the interest in the account, the interest amount will be a little bit more than just the $600. If you take out the 600 every year, you'll never have any more than your original investment. If you leave the 600 in, the 600 itself will accumulate additional interest each year. Do you see that? It'll be a good idea to see that because that's a serious investment issue. You don't want some financial institution to jip you out of your money because you don't understand it. Okay. So compounding simply means leaving the interest on the account and the bank will pay you interest on top of that interest every year as long as you leave it there. So at the end of the day, when you're ready to take money out, you'll have more money if you compound it than if you just simply do simple interest. Okay. Which is why people prefer compounding for obvious reasons. All right. Now, present value. To go back to Enrique's question. Here's what present value means in principle, Enrique. Present value means that if you want to have a certain amount in your account in the future, how much do you need to put down today at X interest so that in 2 or 3 years you have that future amount? So the present value only means how much do I need to deposit in the bank today if I want X amount in the future? Does that make sense?
Yes.
Okay, because once you understand that, then things get a little easier. And remember we said you could do it manually, year by year, each year. It's a little,
I don't like that.
yeah, that's a little stinky. Or
Thank God for those tables. I finally
yeah,
understood
once you
those
understand the
tables.
tables, man, life is easy.
Okay, know the difference. Okay.
Please take your textbook to your class in case you need to refer to your tables. That's all you will be able to refer to, nothing else. All right. If they don't give you copies of the tables, sometimes they forget to give you copies. Make sure you carry a textbook with you.
Well, I think we better call them, tell them, make copies of the table.
Yeah,
How they want it.
yeah, we could, but you know, crap still happens. We tell people stay 6 feet and don't, man, they still go and hospitals are full. See my point? So I could send a big time email, take copies, and they say, gotcha. And then doggone it, by tomorrow morning, something happened.
I forgot.
Or some such thing. Okay, absolutely.
So we better take the sheet or something, copy it.
Yeah, if you can copy your own, the 2 tables, that will be good just in case. Can't hurt. Okay, for sure. Remember, mommy got? Anybody heard that expression? Daddy got?
Mommy got, daddy got, but God bless the child of his own.
Yeah, absolutely. Anybody in this class likes Nina Simone? Most of you guys don't even know Nina Simone. Cheryl, do you know Nina Simone?
I think we
Who's
all
that?
know Nina Simone.
Who
No.
said that?
Andrika, and I think I might be the youngest in this class.
Andrika, how the hell you know about Nina Simone?
She's not anyone you don't know about. Everyone knows about her.
Really?
Well, who is she?
Cheryl doesn't know about her. Andrika, how come you found out about Nina Simone?
I thought that was like common knowledge.
I probably in my bubble.
Nina Simone is from way back in the ages of singing the blues.
It's probably because I like music.
Maybe that's it.
That's fine, but what does it have to do with Nina? Nina's a soulful black chick from back in the 50s or
The
something.
thing is, a lot of the music we listen to today is derived from music that people don't know about. And
Oh,
so, like, I hang around a lot of people who play Junkanoo, and
oh,
they write music. Like, they have to write the Junkanoo song of music that was like, in order to like appease the judges who are probably older than we are, we have to write music that everyone enjoys. So they might write a song from the 80s and 90s. They might write a Nina Simone song. So music is like, it doesn't have a timestamp if you ask me. Good music is good music.
wow.
Yeah, don't have a timeline. Yep, it is. It lasts forever.
It's so refreshing to hear that come from a youngster.
It is.
Because most youngsters will say that's the olden days, and we don't listen to that junk anymore. That's what most youngsters would say. But it's interesting to hear that coming from a youngster, especially Nina Simone. Wow.
She
Okay.
got a taste for good music. That's what that
Evidently.
means.
Evidently. All right. So yeah, God bless the child who has his own. Copy your own bloody tables just in case. All right. So
Make life simpler.
now for the Nina Simone of our class, that's Andrika. I'll call her Nina Simone a couple times just for the record since it was Nina. Okay. So let's say, for example, Nina, that's Andrika. Let's say, for example, you want to have $8,000 in the bank. Let's say what, in 3 years?
Uh-huh.
How much would you have to deposit today? What would have to be the present value today? Let's say you assume the interest rate is 5%, and you want to have at 5%, $8,000, say in 3 years.
It would
How much
have to
would you have to
be,
deposit today using your present value table?
Okay, you have the
First of all, you need to find the factor. Present value factor. 5%, 3 years.
3-year period. That's 0.864 is
Do
the
you see that,
factor.
Andrika?
how is that the factor?
Well, do you have your present value table in front of you?
I do, but why we looking at table 2A?
We look right
Which
below that
table are you
page.
looking at, Cheryl?
Actually, it's on the page, you know. If
I
you
see it,
in,
but like, why
Yeah,
aren't we
but
doing it?
yeah, but you can't use that page on Saturday. You have to go.
no, we have to go to the table with it all. But it's just that they have the same thing. I already checked both.
They have it there, but Andrika needs to be able to see it. She doesn't see that factor yet.
Okay, let her locate the factor.
I see the factor, but my
You
question
see the
is,
factor?
yeah, but why aren't we doing it like you see the first table on that page where it says year 31321?
What about it?
Why aren't we, I don't know, dividing it by 1.05
Oh,
and just
The
working
long way.
backwards?
One thing with Andrika, she always asks the correct questions too.
Mm-hmm.
The one with the division, Andrika, is when you're
Mhm.
doing it manually.
Okay,
You follow? So
I
let's say
follow.
for some reason you forget your tables, you can't copy, you can't get access to the tables.
Oh, you'll do it that way, but you don't have the table.
So now you're desperate. Okay, so what are you gonna do?
Oh,
Yeah,
I'm gonna do it the long way, if that's the case.
exactly. Okay, so what you'll do, you'll have your first $8,000 because that's what you want in the future. And then you have to break it back down to year one, which is the present. So you'll take the future amount of 8,000 in year three, divided by 1.05, and the first year will give you what? Present value. Andrika?
The first year would give me a present value of $7,619.05.
And then in year two, you take that present value and you divide that by 1.05. And what present value does that give you?
$7,256.24.
And then if you do that in year one, which is the present time, and divided by 1.05, what do you get?
$6,910.70.
So in other words, if you want 8,000 in 3 years at 5%, you'll have to put down 6,910.70 today. Got that?
Yes.
If you don't want to sweat with all that calculation, then you go to the table and find the factor. That's it.
And so we could bring this table to the exam, copy it down, and look nice and neat. And
Absolutely, you can carry the table.
okay.
Okay, so you don't have to do all the manual calculations. Doesn't hurt to know how to do the manual calculations, but you don't need to do that. That's why we invented tables. Okay, so now that is what we call the present value of a single amount. What is the single amount in this example?
$8,000.
The single amount that you want in 3 years is $8,000. Okay, so that is the table that you use when you're dealing with a single amount, $8,000 or whatever the single amount is. Now, sometimes it's not a single amount. Sometimes it's what we call an annuity. Do you have that in your book, present value of an ordinary annuity?
Yes.
Okay, Andrika, read that.
It is often necessary to compute the present value of a series of receipts or payment equally spaced over time.
Now, before you go on, the first one was a fixed amount, one amount, 8,000. Now we're talking about what? A series of receipts or payments. Okay, so it's more than one. Keep going.
In other words, the present value of an ordinary annuity. Present value of an ordinary annuity measure. An ordinary annuity is a series of equal payments or receipts that will begin one time period from the current date. Vicky Long has sold a piece of property and is to receive $18,000 in 3 equal annual payments of $6,000 beginning 1 year from today. What is the present value of this sale if the current interest rate is 5%?
Okay, now stick a pin. In the first example, we had the present value of a single amount, correct? Now in this one, we're trying to calculate the present value of 3 of the same amounts. They're usually equal amounts. How much are the amounts each year for the next 3 years?
6,000.
Absolutely, 6,000 in year 1, 6,000 in year 2, 6,000 in year 3. So essentially, at the end of year 3, how much is she expecting to get?
At the end of year 3,
If she gets 6,000 a year?
no.
Okay, Andrika, if you're gonna get $6,000 a year for 3 years, how much do you expect to receive in 3 years?
18,000.
Okay, yeah, it works quite well when it's our own money. Okay, $18,000. Okay. However, what we're trying to do here is to see what is the present value of that 18,000 that you'll get in 3 years. You follow?
I follow.
Again, we can use the tables or we can do it manually. The first example is manual. So year 1, using the present value table of an annuity, not the one for a single amount, the one for annuity. Which table is that?
The one on page 829 and 429.
So if we were to use that one for year 1 at 5%, what rate do you get?
For year 1,
5%.
0.952.
Oh, you mean that same 0.952 that's in your text?
Yes.
Okay. So if you multiply that by the first 6,000 in year 1, what is the present value of that?
The present value is 5,712.
Okay. Then in year two, how much you gonna get?
5,442.
Before that, go back. Go into the actual amount you expect to get. Remember, this is an annuity.
Oh, so in year two, the actual amount that I expect to get is
That's another 6,000.
Another 6,000, yes.
okay.
Remember, 6,000 every year for 3 years.
Okay, okay, I was trying to figure why we use the 6,000 different rates. It's okay. It's each different periods, the same amount, okay.
Remember, if you purchase an annuity investment from an insurance company, they will require you to put in a fixed amount every year of the same amount. That's why we call them annuity, the same
Right.
amount every year. So this is an annuity. Every year for 3 years, you will get $6,000. So we know the present value of the first 6,000, don't we?
Yes.
So what is the present value of the second 6,000? Where did that rate come from?
The table.
Same table?
No, not the.
What's the name of that table we're using for annuity? Does it have a name?
Can we call it exhibit 3?
I mean, do they have anything written on the table, on the top of it?
No.
No? Okay, let me just go down and have a look at mine, see if they. My table 10 says present value of $1 to be received. You don't see anything like that?
Yeah, it's to the side though. I see it now.
Oh, you can't.
Where we get the second rate from?
The second rate still on the first table, exhibit 3. That's year 2.
That's year 2. I see the rate on that exhibit. But where we arrive that from?
See, we in the
Point.
second year, so we have to look at year 2 interest rate
Year
5.
2. I see year 2, and it's at 5%, right?
Yeah. So Cheryl wants to know where the hell that 0.907 came from in her annuity table. She can't see it. Right,
Help.
Cheryl? Folks, let's get the name of the table down correct first.
Present value of $1.
Present value tables has a name. It's called what? Present value of $1 to be received at the end of a given number of periods, correct?
Yeah.
Okay, that's for present value. Annuity, remember, present value is one amount. Annuity is the same amount over a period of time. That's the difference. So the name for the annuity table is what?
Present value of an ordinary dollar annuity received in each period.
Okay. Okay, for those ones done individually, we have to look at the single payment say.
What do you mean by single payments?
The present values.
Yes, that's what I was hoping somebody would get to, so Andrika could see that. Okay?
I like to keep it simple though. I like the periodic payment time, the factor.
I know, we're gonna get to that. The problem is if you're doing it manually, we have to show.
Right, that's the manual.
Okay, so
Okay.
we're still dealing with an annuity now.
Right.
But if you're doing it manually, then you have
You
to
do it by-
calculate using the present value tables for each year. In other words, each annuity payment has to be treated as a single payment.
Yeah, I noticed that's what's happening. That's what used to
doing it,
confuse me
If
until I noticed the difference between the table. When you use the table for the periodic payment, you could use just that factor to make it simple. Anyway.
correct. The real question is, though, does Andrika see that? Andrika, do you see?
Okay.
I see it now.
Okay, so even though we're looking at the annuity of $6,000 every year for 3 years, if you're doing it manually, then you have to find the present value for each year individually, which means you cannot use the annuity table. You have to use the present value table, correct?
Yes.
Okay, so the present value rate for year 1 is what?
For year 1 is .952,
Okay, for year 2,
.907,
and for year 3.
.064,
And if you do that,
.864.
0.864. And so if you take those individual present values and you add them up, then what is the total present value of the $18,000 that you will get in 3 years?
16,338.
Absolutely. If you do it manually. However, if you do the sensible thing and use your table, all you need to do is go to your annuity table now. You don't need that other thing. Go to
But
your annuity
wait a
table.
minute. Excuse me, Mr. Wilkinson, but the funniest thing, you still need the table to do this manually.
To do what manually?
To calculate these things, you still need a table.
Which thing?
The present value
Of what?
for each year. For
That's
the
okay.
single payment each year, you still need to use the
Yeah,
table for that.
that's what I'm saying.
Unfortunately, whereas with the other one, you didn't need the table. You just 1 plus the percentage or multiply it.
Well,
accordingly.
well, now remember, when we did present values manually,
Mhm.
we started with year 3 and divide our way down at 1.5.
Right. Yeah, we
Okay?
didn't need a table at all.
No. Okay? And then without doing it manually, we just gone to the fact of the present table and it becomes easy to do for the
Right.
single amount. Now for the annuity,
You need a table.
yeah, you need the present value table. See, you don't have to do the 1.05 anymore because you now have a
No,
present value
no.
table. So what you do is you find, if you're doing it manually, you'll have to find the present value for each amount each year. Okay? And that will give you 16,338 when you add them up. But instead of going through all that headache, all you need to do is
Yeah.
go to your annuity table.
Oh, keep it simple.
Okay, yeah. Unless the examiner says do it manually.
You're not gonna throw that curveball, right?
Probably not. But you know, examiners do weird stuff just to see if you're present. All right, so if we're using the table, annuity table, then what rate do we get? People still mixing up the table for some reason. It's amazing how students do that all the time. What rate do we get for the annuity using the table?
Well, the periodic payment of 6,000.
For the annuity payment of 6,000.
Oh, the rate we use, the factor, will be
Yeah.
2.723
Times?
times the $6,000, which is the periodic payment, will give you the present value.
Which is
Of
the
the
same as the
16.
annual payment, right?
Right.
Correct. In other words, Andrika, the table allows you to do it faster, and the 16,338 present value will bring in 3 years at 5%, $18,000. That's how present value tables, present values work. One is of a single amount and one is for an annuity. That's where you have to make sure you don't get mixed up. You don't mix them up, you get easy points. You do mix them up, you lose easy points.
I finally realized when doing the homework, the difference in the table.
I
The
know.
light bulb finally came on.
What is truly,
What's the difference between these two tables?
yeah, it's amazing how students get stuck on those tables for a little
Yeah.
while.
It's
So in fact,
confusing.
some of them don't even get it until after the first exam and they got stuff wrong. And then it's,
The table.
oh, that's how you use this table after the fact. But after the fact is not the time you want to get it. So Cheryl, you're in good company by getting it before Saturday. That usually helps. All right. Do you guys have you guys have a section in your text chapter right underneath called time periods? Time periods.
What is that?
There should be a topic in your textbook called time periods.
Time period.
What the hell is
What chapter is that?
same chapter? Right under the annuity stuff we were just talking
Oh,
about.
time periods. Yeah.
Steve, for looking. Okay, So you have that in your text.
Yes.
Does anybody have any idea what Jerry is? That's the honeymooner. What the heck he's doing, you think?
I would like to say he's studying,
No, you can't be
but I doubt it.
supposed to be in class before exams, because that's where you pick up stuff. Like Andrika asked some serious stuff. Cheryl
Yeah,
at
this,
the table. This is invaluable time.
right, and I can't get over that interest.
I know.
Yeah, Andrika just nervous. That's all. She talks a lot when she's nervous.
Point well taken. Okay, so Jerry picked the wrong time to not be in class.
Oh, there was one problem I have. This product warranty still got me.
Okay,
You
hold
having
that
that on
thought.
the exam? This product, calculating this product warranty, don't work. Question.
Well, maybe examinations are funny. It may or may not. That's what I hated about exams all my life.
So can we go with our homework question, please? 445, with the estimating the product warranty and so
Well,
forth.
before we do that, we have to do time periods.
Okay.
Okay, so I need a reader for time period. Anyone? Okay, since Cheryl has the homework question, Andrika asks all the crazy, wild, good questions. That leaves you, Natasha. Time periods.
Okay, Sharon, you can tell me what page that is, please.
Time period is 429
Okay, 429.
at the bottom.
Oh, okay. Time periods. As in all our examples, the compounding period is in most cases 1 year, and the interest rate is stated on an annual basis.
True or false?
However,
True or false? I'm asking.
True, in most cases, they didn't say all cases.
Okay, I may ask that in the test and say true or false, T or F.
Once they don't say all cases.
Examiners do weird stuff. Okay, so don't take it for granted. Keep going.
however, in tables 1 and 2 in Appendix B, the far left columns refer not to years but to periods. This wording accommodates compounding periods of less than 1 year. Savings accounts that record interest quarterly and bonds that pay interest semi-annually are cases in which the compounding period is less than 1 year.
Okay,
To use the tables in these cases, you must divide the annual interest rate by the number of periods in the year and multiply the number of periods in 1 year by the number of years.
so now we have a little twist in the way we used to saying it. All of a sudden, it's not 1 year, it could be semi-annually or quarterly. Once that happens, your approach to the table has to change slightly. Keep going, Natasha.
Present value when compounding period is less than 1 year. Measure. The present value is the amount of interest calculated or compounded more than once per year. Example, compute the present value of a 6,000 payment that is to be made in 2 years. The annual interest rate of 8% and the compounding period is semi-annual.
Okay,
Manual.
now
Mhm.
the principal is how much?
6,000.
6,000. The annual rate is how much?
8%.
Now this is getting interesting. All right, the interest rate to use is 4%. How come?
That's half of 8.
Half of what?
4% is half of 8%, and it's done
How do you
semi-annually.
know it's semi-annual?
Okay, no, it's the annual. It says, right?
It says semi-annual.
It says.
Don't stick to your guns. Don't mind what I say. I
Mhm.
just want to say that to see if you're certain about what you saw. It says semi-annual compounding, correct? So
Mhm.
instead of once a year, it'll compound twice. How do we get twice? How do you get 4%? Take the annual rate divided by 2. Semi-annual. Semi means half. Everybody get that?
Yeah.
Okay. What else is interesting about this? What about the number of compounding periods? Is it 2 years? Is it 2? This is a 2-year transaction. Are the compounding periods 2?
If it's a 2-year transaction, the compounding period would be 4, right? 2 per year?
Why is it 4 and not 2?
Because as you said, it's a 2-year
It's a
transaction
2
period.
years and it's paid semi-annually, so 1 year would be 2, 2 years would be 4.
That's what it is. Normally, remember, we compound annually. Therefore, we wouldn't have this discussion. We'll just say 2 periods, 2 years. This example, it's not annual, it's semi-annual. So we compounded twice each year, so 4 times. That is very important because if you don't get that, you will not get the correct factor. How did we get the factor 0.855 for the present value? How did we get that? What did we do? You have to find the table, you have to find out how we got that factor. Hmm.
Do we have to calculate the 2 years? I think we have to calculate it.
Well, first of all, you need to find the factor. How
That's
did
what I
we
mean.
get-
We have to calculate the factor.
No, you're using your tables to find the factor.
4%.
Well, first of all, which table are you going to use? That's always the problem students have. They choose the
I think
wrong.
we use in table 1.
Why?
Present value, single amount.
Present value, single amount. Thank you very much. That person has it down pat. Because once you understand it like that, you could never get mixed up. Present value of a single amount. Okay, now we can move forward. How did we get 0.855?
The interest rate and the compounding periods, which is 4%. And the compounding period is 4.
Okay, 4% and 4 equals.
4 by 4 gives you 0.855.
Does everybody see that?
Oh, you multiply the percentage, the rate by the compound period?
No,
don't
after we
multiply.
did the,
If you have a semi-annual compounding, you're compounding twice a year. So instead of using 8%, you have to divide it by 2 because it's twice a year.
Right, it's 4, right?
So the rate
We're
will
trying to
not,
figure this 0.855.
you can't get there unless you get the first items correct. First thing you have to get correct is choosing the right table, which is the present value table. Then you have to say, what is the interest rate that you're going to use?
4%.
4%.
Good. I assume you know how we got 4%, because it may not always be that. Okay.
Yes.
And what period will we use?
We should use year 2. I think.
That's over 2 periods, right?
If you use year 2 at 4%, what rate do you get?
I get in the wrong way. I get 0.925.
So you know that's not correct. How many periods should we use in this compounding example?
The total number of compounding periods is 4. It's 2 periods and 2 years.
No,
So
it's not 2 periods in 2 years.
2 periods in 1 year.
so we use year 1 and times it by 2? No,
Well, how many periods in year 1?
2.
How many periods in year 2?
2,
How many periods in total?
4.
4.
Okay, so 4 periods at 4%.
Oh, that's. Okay, you have to go with 4 periods at 4%. Okay.
Should give you that rate.
I don't understand.
What is it you don't understand?
How are we getting that rate?
Which rate?
Just the 0.855.
What is your confusion with that rate?
I know it's 4 periods and I know it's 4%. I don't see a period 4.
Oh, you have to look at the table in the back, but 778.
There's a table in the back.
Partial, that's only a partial portion of the periods on that sheet.
There's
You mean,
a table in the back.
Yeah, there's 4 periods there
so
at
that,
4%.
so that what you're looking at doesn't have 4 periods?
No, it only had 3.
That's in the middle of the book though. You have to go at the back of the book where full table.
Back of the book.
Which page is that?
778.
7.
78.
Thanks.
I encourage you
Yeah,
guys to copy your present value tables, the dollar amount and the new table. Make sure you have the correct tables. The students always mix up the tables for some reason. And they have the right concept and get it wrong because they mix the tables up. Okay, do you see your 4 periods now?
I do. I had the wrong table all the time. And I was like, what are they talking about?
Yeah, that's what happens. You get lost and you put the wrong thing, and then when you get the results back, you're like, oh God. All right. So if you have a 1-year compounding period and a straightforward annual rate, no problem, it's easy. If it's less than 1 year, you know what you have to do. You have to figure it out before you start using the tables and make sure you use
Okay.
the tables, okay? If it's a single amount, you know you're using the present value one. If it's an annuity or multiple payments, you know you're using annuity table. If you ever mix that up, dog eat
Eat
your
your
lunch.
lunch.
Okay. Do you guys have a stop and apply right after that? Anywhere nearby? Give you an example of how to use the tables.
Yeah, we have a stop and apply.
Okay, what does that say? Is it that the $10,000 example?
Yeah, 10,000 at 5% for 10 years.
Okay,
A single payment.
so let's do a quick and dirty review then. Number 1. What's the rate?
Okay, 5%, 10 years.
The rate is,
Percent.
oh,
Don't mix up the.
10 years, point 0.6 to 1. No? Oh, 10 years, 5%. My bad, reading. Go ahead. 10%.
Saturday with the clock. That's still kind of weird.
5%, 10 years.
we looking at the apply it on page 778, right?
Yeah, the $10,000 example.
Right, that's a one-time payment.
Yeah,
At 5% at 10 years, that I have 0.614.
thank you. And you multiply that by 10,000, what is the present value?
Okay, 10,000.
Did I tell you you need a calculator for my classes and for examinations?
Yeah, you did it.
Okay. All I can tell you is what my Grammy told me, hard-head boy don't make good soup.
6,140.
6,140. Okay. Number 2, what are they asking us to do in number 2? With that $1,000.
10,
What is
10
that
annual
$1,000?
payments of 5%.
The 10 annual payments. So is that present value or annuity?
That's annuity.
How do you know?
Annuity.
Because that's a series of payments.
Kiss my foot. Boy, I tell you, learning is hell. Once you get it, it's like a piece of cake. When you don't get it, it's a nightmare. That's all I could say about that. Because you guys came in totally confused about this present value thing. And that's understandable. Get that factor.
5% at 10 periods is you 7.722.
Yep.
Yep. Any of the compounding periods less than 1 year in this example? Any of the compounding periods less than 1 year in this example we just did?
No.
No. Why you guys took so long to answer? There's nothing about compounding being less than 1 year. If it was, it'd be told. You'd have enough information to let you know that it's less than 1 year. I guarantee you it. Okay. What about valuing an asset? Do you have that example in your text? Valuing an asset using present values.
Yes.
Okay. Andrika,
Yeah,
valuing an asset. Do you see that?
I do.
Okay, can you read that section for us real quick?
As already discussed, an asset is something that will provide future benefits to the company that owns it. Usually, the purchase price of an asset represents the present value of those future benefits. If it is possible to evaluate a proposed purchase price by comparing it with the present value of the asset to the company, the present value of an asset measure. The present value of an asset is based on the saving it will generate over its useful life. Example, Mike Yoboa is thinking of buying a new machine that will reduce its annual labor cost by $1,400 per year. The machine will last 8 years. The interest rate that Yoboa assumes for making equipment purchases is 10%. What is the maximum amount or present value that Yoboa should pay for the machine?
Okay, stick a pin. So he wants to buy a machine that will save him $1,400 a year. True or false?
True,
How many years will he save $1,400?
8 years.
8 years. Is this a single savings or an annuity savings?
Annuity,
How do you know?
because it's a yearly saving,
Yeah,
like every year, he'd save
the same
14.
amount. Right? Absolutely. See, once you get past single payment versus annuity, then you're already halfway there, are you not?
Yes,
Because if you mix them up, dog eat your lunch. So now we know it's an annuity. And we're not doing anything manual anymore, are we?
no,
Okay, so we know which table we need to use.
yes,
Okay, so if it's, how many periods is in this example? How many periods?
8 periods
At what rate of interest?
at 10%.
So if you use your correct table, what rate do you get?
Eight periods at 10% is 5.335.
Correct. Times the annuity payment of
1,400.
This gives us a present value of
7,469.
correct. And notice here's why that calculation is so important. We are told your BOA should not pay more than 7,469 or thereabouts, that's my words, for the machine, because this amount equals the present value of the benefits he would receive from owning it. Does everybody get that?
Yes.
So this is a very practical way for managers to make decisions about how to purchase equipment. The first question they ask themselves, how much money is this going to save me a year? Once you figure out roughly what that is going to be every year, you have an annuity amount. And then you calculate the present value of that annuity, whatever that is. And whatever that present value is in this case, it's 7,469. So if somebody says, I'll sell it to you for 10,000, what should he say?
No, thank you.
Absolutely. If they say 8,000, what might he say?
I'll consider it.
Yeah,
I'll get back
8,000.
to you.
Yeah, because that 7,469 is only an estimate, correct? So, but he knows that he shouldn't be paying no more than a roundish 8,000, 8,005 max. And this is the beauty of being able to do the present value calculations. For you personally, if you want to know how much you need to deposit, let's say you're getting an ASU draw, and you want to know, you want to save $10,000 for Christmas at the beginning of the year. The banks are paying 2% interest. Hey, let's do that. 2% interest of a single amount, $10,000. What will be the present value of that in the beginning of the year? Present value of a single amount.
It'll be $9,803.92.
Absolutely. In essence, you will have to, when you get your ASU draw, you want 10,000 at the end of the year, you have to put down 9,000 and whatever that rest of that figure is. And so this is how you can use this stuff even for your own personal lives. Okay? All right. Thank you, Adrika, for bringing up all that. You have opened a kettle of fish that everybody will benefit from, including you.
Thank you.
Okay. Good stuff.
Thank you.
Yeah. Remember, for the payroll journal entry, you have 2 journal entries that you normally make. That long one for payroll for employees, and then a shorter one for
Employers.
employers. Okay. Make sure you can calculate the various interest rates, Medicare rates.
They will be given to us, right?
Of course, and you just have to do the proper calculations. Okay. And I'm just dropping a little hint here and there. Make sure you know how to prepare journal entries for unearned interest. Remember that one? Unearned interest. Okay, Cheryl, what was your question with warranties? Everybody hates it anyway.
I'm sorry, you said unearned interest. You meant unearned revenue?
Yeah, unearned revenue.
Okay.
Let me see if I can find that homework question now. That's on the product warranty. That's the question.
Okay.
That's in reference to estimating these product warranty. What the question, let me find the question.
What page in question is that?
Page
445.
445, P3, requirement 1 and 2.
Okay. And what specific problem that you have? I know you didn't have a problem from the beginning to the end. You probably had 1 or 2 specific problems. What were they?
Okay.
Because remember like when you were growing up and you start counting like 1, 2, 3, 4, 19, 20, the teacher doesn't worry about 1, 2, 3, 4 because you have that down pat. The concern now is how you got from 4.
Okay, let's go over the entire question then.
Why?
Because it's asking us to prepare a journal entry to record the cost of cell phones replaced under the warranty, the
But I mean-
estimated liability for the product warranties for cell phones sold during the month,
So
and so forth.
you mean you didn't attempt to do it at all?
I did.
So you're not
You
confident?
didn't tell me whether I was right or wrong or differ.
You're not
I try
confident
to follow the book as closely as possible.
That's what I want you to do. Follow the book.
But you didn't tell me whether I was right or wrong, so I don't know if I was on the right track or the
Man,
wrong
if you
track.
follow the book, you can hardly be wrong.
Because you didn't give me a feedback, I won't know.
I know.
Maybe it's down to my comprehension.
Oh, got it. Okay. So let me ask your colleagues, any of you guys run into any roadblocks with that question? Let's see if we can work this up for Cheryl.
Personally, I thought it was okay. Now,
Okay.
question 3, I winged it and wrote something down. For that same part, requirement 3, it was kind of like a common sense thing. I just wrote anything down.
Andrika, you're a junkanoo, aren't you?
I
Andrika?
am not. I am home.
Oh, you're not a junkanoo?
No, I am. I think I am.
I have a feeling you are because you love to talk about junkanoo stuff.
Okay.
And if you're familiar with, like, you have to write the music to suit the occasion, you have to be into it to be thinking like that. The rest of us
I-
who are junkanoos, all we want to do is come out and say the valet. That's
Okay.
it. Way to go.
Okay.
Who do you rush for
Let's-
anyway, Andrika?
I don't rush, but
Oh,
I hang around a lot of junkanooers. They are one family as warriors.
oh, one family. So you're the enemy then.
I wouldn't consider you an enemy. I just think we're better than you.
I love it. I love it. Way to go. Okie dokie. They say 3 things you don't talk about: politics, religion, and junkanoo. Okay. So let's go back to Cheryl's before we get to Andrika's like being a question thing to see why she just beamed it. Let's go back to Cheryl's question and see why Cheryl is concerned about it, but Natasha isn't. All right, Cheryl, what's the
No,
first?
Natasha.
Oh, Andrika isn't.
Well, let me read the question.
Yeah.
I'll read it.
Okay.
Okay. Reliance Company manufacturers and sells wireless video cell phones, which it guarantees for 5 years. If a cell phone fails, it is replaced free, but the customer is charged a service fee for handling.
Hey,
In
wait a
the-
minute. Didn't we see that somewhere? The service
Yes.
handling.
Mhm.
Oh, okay. So if it rings a bell with me, I hope it rings a bell with you guys because shouldn't be remember this stuff. Okay.
In the past, management has found that only 3% of the cell phones sold require replacement under the warranty. The
Okay.
average cell phone costs the company $240.
Right.
At the beginning of September, the account for estimated liability for product warranties had a credit balance of $208,000. During September, 250 cell phones were returned under the warranty. The company collected $9,860 of service fees for handling. During the month, the company sold 2,800 cell phones.
Okay, that sounds like the one we did.
Okay, now it asks us to prepare journal entries to record the cost of cell phones replaced under the warranty.
Okay.
So,
Well, the cost of cell phones replaced under the warranty. Well, how many cell phones were replaced?
okay, let me see.
250 were returned.
250 were returned, suggests that 250 were replaced.
Right, 250 was replaced, and the average cost was $240.
Okay.
So that one is relatively simple,
Well,
I would think.
so when you do that multiplication, what journal entry did you make?
The journal entry made was estimated product warranty liability for debiting $60,000. And
you debited a liability account?
yeah,
Why would you debit a liability account?
but aren't I reducing the liability account? Because
Why?
there was they would have estimated at the beginning of September, the account for estimated liability for the product warranty had a credit balance of $208,000.
Mm-hmm.
They would have made this entry in anticipation of these items being returned under warranty already. So that will be reducing the warranty liability account. Won't it?
What transaction is reducing the warranty liability account?
The 60,000,
And where did you get 60,000 from again?
the amount of cell phones that were returned multiplying by the cost of the cell phone,
And how many cell phones were returned?
250,
Oh, 250
right? 250,
times 240
right?
gives us how much?
I got 60,000.
Okay. Anybody else got 60,000?
Yes.
Yeah,
So you guys debited the liability account as well.
You would debit the
no,
product warranty expenses.
that's what I debit.
That's right.
And then
Ah,
I didn't put 60,000 down anywhere.
Oh,
So
it will be the product warranty. Maybe I pick up-
well, let's back over from
Estimated, maybe I have to write it
Carol for a
down.
moment. And why did you guys debit product warranty expense?
Following the book.
I think I just probably labeled that wrong.
Aha, that's very possible. It happens all the time. Okay, and so we debited product warranty expense for how much?
60,000.
Okay, and then what
I
is it?
have a different figure,
What figure do you have?
20,160.
Where the heck did you get that from?
With this, the estimation formula they gave us
Okay, I mean, like, what formula is that?
to record estimated product liability, we times the number of units sold by the rate of replacement under the warranty. And then we times the
That would be
answer.
part B.
That's part B. That's another one, I think.
Oh, I do probably, okay, all right.
Okay, so let's back up. Yeah, that's getting into B. That sounds like B to me. Let's go back to A. What was the question for A again?
The cost of cell phones replaced under warranty.
Oh, yeah. Well, the cost of cell phones replaced under warranty involved two costs, correct? Or just one?
I would think that's the replacement cost, eh? Wouldn't that be just the replacement cost of $240?
Okay, so let's say 240 times 250 returned is equal to how much?
$60,000.
That's the 60,000.
And which account did we debit for 60,000? What account did your textbook debit when items were returned?
Product warranty expense
Question or statement?
statement.
Statement. The textbook debits product warranty expense for return items, correct?
Yes.
So in this case, we debit product warranty expense for $60,000. Then what do we do? What do we credit?
Merchandise inventory.
Estimated product warranty liability.
Aren't we reducing the inventory?
No, are we?
Plus we replacing, inventory is coming out, right? You're replacing the defective cell phones, right?
See, what I'm trying to establish here is the sequence. If you go back to your textbook and you, what was the first exercise journal entry that was made in your text? Example. Because the sequence is very important. What was the first journal entry that was made in your text?
We debited product warranty expense.
And credit?
Estimated product warranty liability.
And how did we arrive at those numbers?
That's the calculation we did. Or that the book did.
I know, what calculation was that?
2 times the number of units
Done.
sold by the rate and then times that answer by the estimated cost per unit.
And what total did you guys get for that journal entry?
But that one was 20,160.
160.
Yeah.
Okay, and to get 20,160, what did you do?
We multiply the number of units sold, which is 2,800,
Uh-huh.
times the
3%.
rate of replacement, which is 3%,
Which is 3%, which equals
84, which
84.
is the estimated units to be replaced.
right.
And then we times the estimated units, our answer, which is 84. We multiply that by estimated cost per unit, which is 240.
Right.
And that's how we got our answer. Estimated
number one.
liability for product warranty.
For number one.
Is it number one?
Is it number one?
No, that's number two.
B
I mean, that's
part,
B.
Are we still in B? So we
Yeah,
need
that's
to go,
B.
okay, B, that's fine, B. We need to go back to A. Okay?
Okay.
Which is where Cheryl is still stuck
Lost.
in A. So what did the question say we need to do in A?
The cost of cell phones replaced under warranty.
Okay? How does your textbook handle the cost of cell phones replaced under warranty?
Gotta find that.
Uh-huh.
I thought they would be reducing the inventory again. You're saying that's not correct?
No, I'm not saying that's not correct yet. I'm just curious as to how your textbook responded to that part of the warranty question. So what was the full question for question A, number one? What was the full question again?
Reliance Company manufactures and sells wireless video cell phones, which it guarantees for 5 years. If a cell phone fails, it is replaced free, but the customer is charged a service fee for handling. In the past, management has found that only 3% of the cell phones sold required replacement under the warranty. The average cell phone cost the company $240. At the beginning of September, the account for estimated liability for product warranties had a credit balance of $208,000. During September, 250 cell phones were returned under the warranty. The company collected $9,860 of service fees for handling.
Okay,
During the month, the company sold 2,800 cell phones.
interesting. And the question number one is?
The cost of cell phones replaced under warranty.
Interesting. You don't have, I thought, I'm almost certain that we discussed that cost of replacement. Because the cost of replacement also included the replacement cost of 9,000 something, didn't it? Where's that section in your text that we discussed? Because remember, if you're replacing, there was a replacement cost of $30 per unit or whatever in our example. Where is that in your textbook?
The transaction where the customer returned a defective muffler,
Of
which
course.
cost $60 to pay $30 service fee.
Yeah, why not? It's the dollar amounts are three, but the principle is the same. When the customer returned the muffler, what journal entry did we make?
What page is that?
What page is that? That muffler.
421.
Okay,
The transaction notes on 421, the journal entry on 422.
so the customer returns one muffler. Right?
Mhm.
What journal entry did we make for the return muffler?
We debit cash. Cash increased because of the service fee.
How much did we debit cash for?
$30.
So in our homework example, if the service fee was how much?
9,860.
How much?
9,860.
So let's do the same thing, debit cash. Okay, what's the next thing we did for the muffler?
We debited estimated product warranty liability.
For how much?
That was 2,100, but in our homework it was 20,160.
Somebody said, why you said that?
Okay, the example has cash for 30 and then estimated product warranty liability for 60.
Oh, it does have it for 60. That's because it's one muffler. Sorry.
So where did that 60 come from?
That 60 was the cost of the defective muffler, or that's the cost of a muffler.
Yeah, that's one
You
muffler.
mean the replacement cost?
Yeah, that's the replacement of the muffler. That's why initially did the estimated product warranty liability is at the cost of the replacement of those 250 cell phones.
Yeah, we're getting,
And I
yeah,
credited the merchandise inventory.
yeah, we're getting warm, but let's go back to the 60. What's the name of that account that we debited for 60?
Estimated product warranty.
Estimated, yeah, product warranty liability. But
Okay, so
you were saying that the product warranty expense should be debited.
no. That was the initial discussion that came up as part, somewhere in question 2. That's why I said, well, let's go back to the muffler. We debit cash for the replacement cost, which is $30 and 9,000 in our example, correct?
Correct.
Okay, the second debit was for $60 for the muffler. Where did the $60 come from?
So I was assuming that, we sold 42 mufflers and that our estimated liability for the product warranty was 2,100. I divided 2,100 by 42, but it isn't 60. I got 50. So I have no idea where the $60 came from.
So you mean they just threw that there?
It kind of
I
looking like.
hope not.
That's any some customer returns with a defective muffler,
Keep reading.
which cost 60. The cost of the muffler was $60.
Yes, the replacement cost is $60. Now, do we have a replacement cost for the cell phone?
Yeah, yes, the $240.
That's the replacement cost? So
Right.
That's the replacement cost times how many cell phones? Okay, so we have to
250.
debit an account for 250 times 240, which is the 60,000, Cheryl?
Right.
Okay, so what is the
Yes.
name of that account that we're debiting?
What I put estimated product
What is-
warranty
what is-
liability.
no,
You said it was
no.
wrong. Based on the example with
Yeah,
the muffler,
the
it
muffler-
would be.
The
Because
muffler's
it's-
account for 60,000 that we debited, what was the name of that account?
Estimated product warranty liability.
Okay, so that should be the name of your debit.
That's what I had. Y'all threw me for a loop. Y'all
No,
said
no.
that it was the product warranty expense
No,
account.
no, that's because they were in part in question 2. That's why I said leave question 2
In
and
part
go back
A.
to question 1.
Okay,
All right.
okay.
So
Oh.
following our text now, we have a debit to cash for 9,000 and how much?
860.
And we have a debit to product liability for how much?
60,000.
Good. Now, what do we credit in the muffler example?
We credit the merchandise inventory.
That's all we credit?
Yes,
revenue.
in that example.
And service revenue.
And the service revenue, if you're booking the service revenue for the cash, yeah, you would do that.
Well, we have to book the service
Okay,
revenue.
yeah,
So we credit service revenue for how much?
$30.
I mean, in the homework. The cell phone.
And the homework is 9,860.
Okay, and what else do we credit?
Merchandise,
How
inventory,
much? Cheryl, how much did you put for merchandise inventory, Cheryl?
Merchandise inventory, I put $60,000.
$60,000. Anybody disagrees with her? What is the merchandise inventory for the muffler?
$60.
So Cheryl is correct.
So I only did have one part of the question. I don't think I booked the service revenue with the cash.
Oh, you didn't do that. Well, you
Yeah.
can do it as one compound entry like we just did, or you can do two separate entries. You understand what I mean?
Mm.
You can do one entry for debit to
Let's see,
liability.
what was this question now? Let me see if I read this right. The cost of cell phones replaced under warranty. Okay.
Yeah, that's the replacement cost, which is the same as the $60 for the muffler.
That's the 60 plus the 30.
Yeah, you can do it as one
Oh.
compound journal entry or two.
You see, they should have they don't give me everything. I was just looking at the replacement cost for the cell phones, but they really want us to record the replacement cost and the service cost then.
Of course, definitely.
So,
Because see, you cannot replace the cell phone without incurring the cost to replace them because they're making money to replace them, remember?
right.
So you have to record the revenue that they earn at the time they replace them together at the same time.
But Mr. Wilkinson, you didn't give me a feedback on my question, on my homework.
I didn't do
So
what?
I would have never known I was on the right track or the wrong track.
That's why I'm doing it now.
Good thing I raised the question now.
That's the whole idea. That's what happens when you take initiative. Of course, I could have called you and said, this should be that, and that should be that. And oh, you write it down, you'll forget. But after tonight, you won't forget. I guarantee you. That's why I like to keep it for moments like this, so we can bring it out and everybody doggone get it. That's the idea. So what would be your entry for the revenue, Cheryl?
For the revenue?
Yeah,
Oh, the service revenue? Oh, on the phones. Oh, I
yeah.
never did calculate that. Okay, company,
The muffler example will help you if you need to.
980, oh. Okay,
What would you
for the
debit?
we will debit the cash and we would credit the service revenue
For how
for
much?
the 9,000. What was that? $9,860?
Okay, and what would you entry would you make for the warranty transaction?
The warranty? Didn't we do that already?
Yes.
That would have been the estimated product warranty liability for 60,000 and the merchandise inventory credited for 60,000.
Thank you very much. Now we can move on.
So there was no expense account in that.
No.
Okay.
Isn't that wonderful?
Mhm.
Okay, so is that the rest? Is that all the homework question?
No.
There's more?
Okay,
Yeah, that,
for the for part A, we'd be debiting,
Wait, this is the same question?
yes.
Okay, what does the question ask us to do?
No, I'm asking you to repeat the journal entry for part A.
What is part A?
The cost of cell phones replaced under the warranty.
Oh, under the warranty? Okay, Cheryl,
Yeah.
that's your answer. What is the journal entry? Cheryl?
beg your pardon?
She wants to know what is the journal entry for the replacement under warranty?
The journal
The
entry
cost of
was
cell phone.
estimated product like estimated product like 1 minute. Estimated product warranty liability. I debited for $60,000. And the merchandise inventory, I credited for $60,000. And for the service fee, I would have debited cash for the $9,860 and credit service revenue for
There you go.
$9,860.
Perfect.
Okay, thank you.
Now, any other parts of that homework question?
Okay, yeah, there was a part B. Let's go
As
through
a
it.
part B?
D-
Do we need? to
Yes,
do
yes,
it
this was a little, you did one requirement 1 and 2 plus. Okay, the second part was the estimated liability for the product warranties for cell phones sold during the month. Okay, so we needed to prepare the journal entry for that. The estimated liability for product warranties.
sold for the month?
Mhm.
Well, how many were sold for the month?
Okay, 2,800 was
What's
sold for the
the
month.
estimated warranty liability that they've estimated for the company? It's right in the narrative. They told you at the beginning in the narrative what the rate is that they use to establish product liability. Natasha read it as well, again.
Oh, it's been a long day.
Tell
I'm
me
drawing blank right now.
Anyone? What's the liability percentage that this company uses to determine its product liability?
3%.
That's
3%. Remember, when you read the examination questions, you have to read them very carefully and keep looking at it, or else you're going to forget that information is in there that you need. Then you're going to get stuck and forget it's in there. You have to always be looking at it. So when you need something out of it, you can pull it out. So if it's 3%, how many products were sold during the month? How many products were sold during the month?
2,800 cell phones. I guess at the cost of $240, say.
Well, we don't get the cost yet. We're just trying to find out if 2,800 was sold during the month, what percentage of that we estimate will be returned?
3%,
3%.
So what is 3% of that?
84.
And what is the cost,
The cost per unit is 240,
which equals
20,160.
that number we had at the beginning when we mixed up the numbers? Absolutely.
Do that again. What we did there?
Okay. First of all, we determine how many units were sold in the month. How much is
Right.
that? How much is that?
2,800.
And then we have to multiply that by the estimated rate of return, the product liability return,
Okay.
which is?
Now you see where I probably did this wrong. I looked at it saying that 2,800, I give this dollar value, but it's actually 3% of the
No,
cell
we're
phones
gonna
being
get to the
returned.
dollar value, but the dollar value is the easy part. The part where you get stuck is determining the product liability rate. In this example, the product liability rate is
3%.
times the amount of units sold. So how much do we expect to be returned?
Okay, I got it. Times 0.03.
Times
84.
84 times the cost of the unit.
Okay.
$84 times the cost of the unit is what? Now, there are two types of calculators, real and the other ones. You should have a real calculator. What's the amount?
2,160. 20,160.
What did you say two?
I said 20,160.
I know, at first you said 2,160.
No, I didn't say, I just reading wrong. As I said, it was a long day, so. I can see anything right now.
So it's 20,160. What's the journal entry? Anyone?
Um,
I am a bit confused, Mr. Wilkinson. Why
I-
won't we have get the total cost on the total cost of the amount of cell phones sold during the month? Why
I know,
won't we
I
calculate?
know why you're confused, because you want to do it the way you want to do it. Here's how you want to do it, Cheryl. You want to take the 2,800 that was sold times 240, right?
Mm-hmm.
Do that.
Unless,
No, do that first and tell me what number you get. What dollar value do you get for the 2,800 sold?
2,800 times 240.
Equals?
I got this right.
Equals?
672,000.
Okay, let's assume that calculation is correct, that arithmetic. That's how much you sold for the month, right?
Mm-hmm.
But according to your company's policy, what percentage of that will be returned?
3%. 3%.
So what is 3% of that?
20,160.
Same thing.
Okay. Okay.
I did the other way so that because I know you're familiar with doing the dollars first and then applying the rate. But I just want
Mhm.
to see that if you apply the rate first and then you do the dollar amount, the unit amount attached, you get the same answer, so you don't be stuck. Either way, you still get the correct answer. Okay, but whatever way works for you, that's the approach you should use. So in your case, you want to do the dollar value first times 3%. Other people can do the 3% times the dollar value. You follow?
Okay.
But the end result is the same. What journal entry will we make for the 20,160? Because after all that, we still have to make a journal entry.
debit product warranty expense
Okay?
and credit estimated product warranty liability.
Absolutely. Debit the expense account, credit the liability account. Is that the end of the questions that I asked you to do?
Oh, okay. The requirement two was compute the balance of the estimated product warranty liability account at the end of the month.
Didn't we only have to do requirement 1 and 3?
They thought it was 1 and 2.
1 and
One
2.
and
I didn't assign any 3s.
Oh, that's interesting. That's why I said I winged it, because I didn't know what's going on.
No, requirement 1 and 2.
Okay.
But of course, answering 2 is easy if you get the journal entry correct for the 20,000, right? If you post the journal entry for requirement from requirement 1 for the product liability, if you post it, what would be the balance of your liability account? Now is the time to use your posting. They tell you what the balance was at the beginning of the question before the transactions. Now, after posting the transactions for liabilities, what is the balance in the liability account?
I got 168,160. I don't know.
What was the balance in the liability account before we started doing the journal entries?
208,000.
208,000.
Right.
Did we put any debits to the liability account?
The 60,000.
And did we put any credits to the liability account?
Yes, the 20,160.
So if you posted them correctly, then balance your account and tell me what you got.
I got 168,160.
Okay, does everybody else get that? Does everybody see how she got that?
No.
Okay. At the beginning of the question, they gave you a liability account. What was the name of that liability account?
That was the estimated liability product. I mean, estimated product warranty liability account.
Good. Now draw a T account with that name and put the balance in the account that they gave you.
Actually, that's what I did. I drew my T account.
All I could tell you, have scrap paper. T accounts can be very helpful to help you see things, especially when you have to come up with balances. And even when you don't, it helps you to see things better. A lot of students don't like drawing T accounts because they think it's tedious work and they get mixed up. And they want to know why they're mixed up. Even professionals use T accounts when they're dealing with complicated transactions so they could see. So do we all have a T account marked product liability, blah, 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 with the balance in it?
Yes.
Okay. What's the first transaction that affected that account?
The opening balance
Of how much?
at the beginning of September, it was 208,000.
Okay, so that doesn't affect it. That's the opening balance. Great. What's the next transaction that affected that account?
The replacement cost of the cell phone for 60,000.
Debit or credit?
That's a
That's a-
debit.
So post it as a debit to the account.
Right.
Since you guys need some posting practice, which you should have done in accounting one.
And then there's the second transaction,
Which is?
the product warranty of $20,160. We credit that.
Okay. So if you draw a line under the credit out, you put that credit in, draw a line under that, and draw a line under the debit. And out of the two columns, what do you get?
168,160.
What is the total debit in the debit
The
column?
total debits is 60,000.
And the total credits?
It's $228,160.
Good. Now,
Yeah.
when you take one from the other, you end up with a credit balance of?
168,160.
Good. That's how your ledger should look. And if you don't do it that way, you could get mixed up and you won't come up with the correct balance. Because you're trying to subtract and add stuff in your head because you think you don't need a T account because it's wasting time. All right. Does everybody see that?
Okay, I see what I was doing wrong.
Yes.
Well,
Thank you, Cheryl, for insisting on that.
sometimes you could be clear as mud.
You better believe it.
I said it's easy.
So,
You're putting these things down, but you're just looking at example.
yeah, sometimes it's as clear as mud until you really clear it up for real. All right. All right, so you guys asked some great questions. I don't think there are too many others that could have been more important than those questions. I believe you guys should have a handle on all the other crazy stuff. The ones you asked tonight were the ones that I was hoping you would ask, because they're usually the ones that create problems for students going into this kind of midterm exam. So hopefully you've been practicing and studying and practicing. Practice is the key. All right, if you want to do yourself any justice between now and Saturday, which you should have been doing from last week and the week before and all that stuff anyway, is to have been practicing those things. The fact that you did the homework is going to be a great help to you between now and tomorrow night while you're working. Just practice. Even if you redo the homework questions from each chapter, redo them one more time in preparation for Saturday morning. Take tomorrow off, tell them you have COVID symptoms so you could practice and all that stuff, and then you'll be ready and comfortable, hopefully, for your examination on Saturday. Any other questions before we break so that you can go and do more questions?
I think we'll call it a night.
Yeah, it's been a very, turned out to be a rather enlightening evening. I didn't think that we'd have to get into all this, but I'm glad you guys raised it because every single question you asked was a critical one that I hope will be beneficial to everyone. Okay. All right. So good luck. And on Saturday, don't forget you need a calculator. Please put your answers in pen. Do not give me any answers in pencil, please. If you make a mistake in pen, do not scribble and scotch it. Just put one line through the error and then put in the correct number that you want. Okay? Whatever you do,
Okay.
use a pen. Do not use whiteout. If you make an error, do not scribble through it in frustration, like doggone it. Just put one line through it, put the correct answer, and move on. Okay? Fantastic. Good luck, you guys. Take care and be safe out there.
Okay.
Okay.
Thank you. Good night.
Good night.
Good night.
Good night.
Good night.
Night, everybody.
Jenny.